Have you made me into a panelist? I mean, the co-host or something like that.
Uh, yes, we are live right now. Yeah.
Okay.
All right. So, welcome everybody to this webinar brought to you by Bursa Malaysia that is titled Sharia-Compliant REIT, a Malaysian investor's perspective. So, welcome to this session. So, today we have hosted someone who is very experienced in the REIT to tell you more about IREIT. Okay, IREIT means Sharia compliant REIT. Okay, REIT stand for Real Estate Investment Trust. So if you want to own a portfolio of properties, especially at prime location, then real estate investment trust is a financial instrument that you must look into. All right. So right now, let's slowly wait for people to join in. Okay, if you are ready for this session, type yes. Okay, if you're ready for this test session, type yes. All right. Yeah, there are many people here.
Yep. Wow.
Wow, it's a Friday evening. I want to thank all of you for showing up. Okay, so allow me to introduce myself. My name is Shen Chu. I'm the moderator for these sessions, and this session is brought to you by Bursa Malaysia and managed by LifeChamp. So before we begin, just want to tell you more about disclaimer. As usual, whatever we share on this webinar is only for educational purpose. In no circumstances that we give any recommendation to buy or sell any companies or any REITs. So if you decide to buy or sell any companies as a result of this webinar, you do it at your own risk. Okay, allow me to introduce our speaker today. Our speaker, Ian Tai, is a content producer of kclaw.com, and he has personally written over 100 articles on kclaw.com, and he's also a regular webinar host and presenter for kclaw.com. And he is also a co-founder of Dividend Vault, as Ian manufactured competent dividend investors who can build and manage their own dividend paying stock portfolios savvily and independently. Okay, so Ian is definitely famous for manufacturing dividend investors. Okay, and he himself is a dividend investor. He invests primarily for dividend income, averaging is about 4 to 8% yield a year. So that is his portfolio's dividend yield, which is an incredible result. So without further ado, okay, let me hand over a session to you, Ian.
Yep, Shane. All right. Once again, thank you so much for having me today on this webinar. And it's always a pleasure to have a webinar with you. And with that, let me just share screen because I have prepared a lot of materials for you guys. Okay, so can you see my screen, Shane?
Yes.
All of you can see, yeah? So with that, let me just get right away with the content. So here is the overview. So in this webinar, I'm going to cover three things. The first one would be the difference between Sharia compliant REIT, or I would just say IREIT because it's easier to actually mention. So IREIT versus convention REIT. All right. So what are the differences between the two? And we are going to talk about the financials. All right. So which means to say, as an investor, we will be looking at the finances of the REIT, and I'm going to share with you a shortcut where you can actually decide whether or not you want to continue on to study on this REIT, which means to say whether or not you want to look further when it comes to investing in this REIT. And all you can do is a 10 minutes test, and you apply on the finances, and from there you can tell whether or not this is the REIT for you. And the third thing that I would like to share is this one, okay, which is a bit tricky. And this is actually a calculation. So I'm going to share with you how I calculate the net distribution yield of any REIT, be it Sharia compliant REIT or conventional REIT. So it applies to both. And I'm going to use for IREIT today because today's webinar is about IREIT. So with that, let's get on to part number one, which is IREIT versus conventional REIT. So over here we have a screenshot of Bursa Malaysia's official site, and this is actually from there. As we can see, we have about 17 REITs, but 4 of them are IREITs. So they are as follows. The first one would be Al Arca KPJ REIT. Actually, this one is a bit outdated because it's now renamed to Al-Arka Healthcare REIT. All right, so this one is basically a healthcare REIT. The second one will be Axis REIT. Axis, this one is actually more like an industrial REIT. And the third one will be KLCC Staple Securities. So this is the only staple securities that is listed on Bursa Malaysia. And this is by far the biggest REIT among the 17 REITs which are listed on Bursa Malaysia. And the fourth one would be El Salam REIT. So El Salam REIT is more like a retail REIT where it has more retail, where its portfolio, it comprises of retail, offices, and industrial purposes, yes, but most of the properties owned by El Salam would be for the retail one, which is, if I can recall, it's actually JBCC, which is their main trophy asset, okay? So these are the 4 REITs. And of course, if you want to have the full list of all the Malaysian REITs, we have on our left-hand side, the Shariah-Compliant REIT, which I've just mentioned, Al-Arka Healthcare REIT, El Salam, Axis, and KLCC Staple Securities, whereas the rest, all right, as you can see, from Amanah Raya REIT all the way down to YTL Hospitality REIT. So these are all conventional REITs. So now I'm gonna dive into what are their differences, okay? Why some REITs are renamed or reclassified as iREIT and why some stays on as conventional REIT. So basically, in order for a REIT to be reclassified as a iREIT, they need to fulfill certain requirements. And basically, after I have done some research here and there, I have actually compiled 4 main criteria that a REIT should actually fulfill in order to meet the requirements of an iREIT. So these are the 4 things, okay? And for those of you who are listening and maybe you are a Muslim today and you are more well-versed with the Sharia, anything related to the Sharia compliance stuff, right? Then please do feel free to actually feedback to us, all right? Because these are all my own personal studies, all right? And my personal findings when it comes to the requirements. Okay, anyway, let me just continue. So these are the 4 main requirements. The first one will be the activities. The second one will be the financing. The third one will be the property insurance. And finally, the fourth one, it's the reporting. And the reporting here refers to the annual report. Okay, so let's go to the first one. So when it comes to activities, right, there are 2 main criteria. The first one is the rental income. Okay, so let's say, for example, an iREIT may own some properties. And then the properties, how to get income is they can lease it out to their tenants. Okay, so now the tenants here play a very important role, because if the tenants here, if let's say they do businesses like, let's say Starbucks, for example, okay, they open, let's say you have a shopping mall and you open Starbucks, and Starbucks, let's say it's is Starbucks halal? Shane?
I actually don't know, because they are not a US listed, they're not a Malaysian listed company.
Okay.
So they are not screened by Sharia Advisory Council.
Okay, that one I'm not too sure.
So
How
there's
about
no
KFC?
Sharia status on Starbucks, this company.
Okay, let's be safe. Let's say McDonald's or KFC. All right. So let's say a part of the property is leased out to KFC and McDonald's, where they have the JAKIM approvals and stuff like that. So that is actually a compliant activity. So if they have that kind of compliant activity, then very good. Okay. So they must actually rent it out to businesses where they are Sharia compliant. And of course, sometimes unavoidably, sometimes you may actually rent out a portion of the property to businesses where they conduct some non-compliant activities. Maybe they sell tobacco, or maybe they sell wine in a shopping mall. Okay, so that is actually non-compliant activity lah. All right, and the proportion between the two, all right, the proportion is actually set by the Sharia Advisory Council of the Securities Commission of Malaysia, whereby these non-compliant activities, right, must be below 20%. All right, so if you have a portfolio of properties, you must actually meet below 20%. So that is actually the criteria set by the Sharia Advisory Council of the Securities Commission. So that's the first one. And the second one is this. So let's say, for example, you have a portfolio of, let's say, 10 properties. And after you have actually after you have actually looked through the whole 10 properties, right? All the properties in general, in aggregate lah, it gives you below 20% when it comes to the non-compliance. Okay, so you may actually fulfill the first one, but there is a second one. So the second one is, let's say out of the 10 properties, right, got one property. All right, let's say you own a small factory, and then the factory, right, is a tobacco manufacturing. It's actually fully leased to a tobacco manufacturing company. All right, so tobacco manufacturing is actually a non-compliant activity. So can the REIT own this kind of property? The answer is no. Okay, means to say you cannot have one property that where the entire tenant who actually occupies the property, right, derives income from non-compliant activities. Later I'll give you the list of what are the non-compliant activities that I can find, all right, from my findings. So the first one, the activities, very important. Okay, and now let's look at the second one. So the second one is this. The second one talks about financing. Financing here talks about, let's say, for example, if the REIT actually receives rental income from the tenant and they got cash, okay, and where do they keep the money? They cannot actually just say, oh, I got the cash and then I just put it in some conventional bank. So that one is also part of the requirement. Okay, they cannot actually just put money into a conventional bank. The cash that they hold, they must actually put it into, let's say, a financing instrument or an investment instrument that is Sharia compliant. Let's say they put it in the Islamic bank. Okay, then yes, or an Islamic account. Then
Islamic bank accounts, yeah.
Yeah, an Islamic bank account. Then that would be Sharia compliant. And also, when it comes to financing, sometimes you may want to buy a piece of property, and most of the time REITs will actually get borrowings to finance this property, get a property loan or mortgage. So this kind of mortgage, you cannot get it from a conventional bank. You must get it from an Islamic bank, and it's Islamic financing. So if, let's say, that REIT, okay, it keeps its cash in the Islamic bank account and gets its loans. I won't say loans lah, because loans is mostly for conventional REITs. But let's say you finance the purchase of the property through a Islamic financing instrument, then that is Sharia compliant. So the Islamic REIT or the REIT must fulfill that criteria.
Because the conventional accounts, is against the principle of riba.
Yep, it is actually against the principle of riba. So that's why there's no you cannot have any sort of financing, any sort of investment, all right, that is actually placed under a conventional, anything to do with conventional bank. So you cannot do that. The third one will be the property insurance. You cannot just say, oh, I'm going to get a property insurance from an insurance company. You must actually get takafu to insure the real estate inside the portfolio. So that's the third one. And finally, for REITs, right, it's very important that you can actually find this section in the annual report where it includes the Sharia advisors report. Okay, so which means to say they have a Sharia advisors committee that will actually screen through all the property portfolio, screen through the financing instruments, screen through the deposits and investment instruments, and as well as the insurance contract to make sure that the REIT fulfills all the requirements needed to become an REIT. So these are the 4 main criteria. Okay, and right now I'm going to give you a list of what are the non-compliant activities. So they are as followed. Number 1, conventional banking. So which means to say, of course, if you talk about renting your property premises to Maybank, CIMB Bank, then of course that's an advantage of non-compliant activity. Number 2, conventional insurance. So let's say you rent it out to Great Eastern Life, then that is actually conventional insurance, all right, which is an example of non-compliant activity. Gambling, of course, you can't have a commercial property that is rented out to Berjaya Toto and stuff like that. The fourth one, liquor and liquor-related activities. Of course, you can't rent it out and you rent it to someone who is actually selling beers and liquors, alcohols, pubs and stuff like that. So you can't do that. Fifth one would be non-halal F&B activities. For example, pork and pork related activities, these are prohibited under the Shariah. These are actually part of the non-compliant activities. Tobacco is one of them. Number 7, stockbroking and trading of non-compliant securities. So this is actually part of them. And number 8, we have entertainment activities. Anything that is non-compliant, so that is actually part of the examples, okay? Part of the examples of non-compliant activities. All right. So now from the Shariah's Advisors Report, you can actually find out the percentage of non-compliant activities of throughout the entire portfolio. All right. So I have actually gone through the 4 REITs annual report, and from there I have discovered the percentage of non-compliant activities. So like Al-Arqa Healthcare REIT, the percentage is 0. And lately they have their 2020 report, and I'm happy to say that Al-Arqa Healthcare REIT, the percentage remains at 0 in the year of 2020. Of course, that's as a hospital, as a property, as a REIT, I-REIT that owns healthcare properties like hospitals, aged care facilities. Of course, it's very hard to have non-compliant activities. Al Salam, because it has some retail element, so understandably it has a little bit of non-compliant activities at 3.26%. Axis REIT has 1.35%, and KLCC Staple Securities at 1.18%. So the only REIT, if you want to be super clean from non-compliant activities, well, basically you only have one choice, which is Al-Arqa Healthcare REIT. If you want to be totally, you want to be totally Sharia compliant free, then Al-Arqa is the choice, all right, because their percentage is really 0. Okay, otherwise you may have a little bit of a slight percentage of the non-compliant activities. So now with that said, right, so I'm going to just share with you what are the advantages and restrictions of an I-REIT. So let's start with the advantages. So let's say a REIT has been reclassified into an I-REIT. So the good thing about becoming an I-REIT is this. So number 1 is that they will have access to capital from Islamic funds or from capitals or maybe investment funds from Muslim investors. All right. So there are a Muslim community who are investors, they are savvy investors, and they want to attach their investment with their values. Okay, they want to invest based on what they believe in, based on their ethics, based on what they truly want how they want their money to be invested. All right. So if you want to attract this kind of capital, then of course it's very good for a REIT to be classified as an I-REIT. That's the first one. The second one is this. Of course, if you reclassify as an I-REIT, you're not going to do, you are not going to, how would I say, the REIT, right? Okay, which means to say you're supporting a REIT that is doing businesses which actually more or less improve the social welfare of the community, simply because you're going to eliminate some activities which are not that beneficial to the society. All right, let's say for example tobacco, all right, or let's say for example legal company, okay, or let's say for example anything which is not so social welfare friendly, right? Then of course they when you invest into this I-REIT, right, then of course you're promoting, you're in a way not only just investing for your returns, but you're also trying to use your money for the better good, which is to improve the social welfare of this country and of course the community in general. So these are the 2 key advantages I see of a REIT being reclassified as I-REIT. And with that, let's look at some restrictions. So restrictions, number 1 is that inevitably, when you classify yourself as an I-REIT, there are certain tenants, right? You cannot actually, as good as they are, you can't actually make money. You won't want to make money from them because you already classify yourself as an I-REIT. Like for example, if you have a shopping mall and let's say a bank, a conventional bank like Maybank or Public Bank, comes to you and say, "Hey, I want to rent from you this maybe 20,000 square foot of retail space, can or not?" Then you're already an I-REIT, So the answer is of course not. If you want to continue on being an I-REIT, then of course it's less likely you are gonna make money from this kind of blue chip tenants. So you might actually exclude out some income generation opportunities from these high quality tenants. Number two, you may exclude some quality properties that could be great investments when growing your the REIT's real estate portfolio. So what do I mean by that? Remember when I say that an REIT, right? You cannot actually invest in a company, and you cannot invest in a property where the entire property is being leased out to a business that is doing non-compliant activity. Like let's say, for example, you are into storage of liquors. For example, let's say you have a warehouse property. You have a warehouse where all the spaces inside there is to store liquor, and this warehouse, right, is owned by one of the largest brewery house in the world. It's a good property. The tenant, the person who occupies the property is very good, and they want to strike a deal with you. They want to sell off their property and lease back the property to the REIT. Can or not? Then the answer is no, you cannot do that. All right, because that is actually part of the restriction. If the REIT proceed with that kind of deal, then of course the REIT will no longer be an REIT, but rather it may be risk itself falling back into a conventional REIT. And then the third one is this. This one I think is a bit subjective. It can work both ways though. When it comes to choosing financial products, all right? So remember, like what I said, the REIT can actually receive cash from its tenants. And from this cash, right, so where do you want to deposit the money? Is it into a conventional bank or is it an Islamic bank? So if let's say the Islamic bank account gives a better deal, then of course it will be an advantage. But if let's say, for example, the conventional bank is giving better interest or a better deal to a REIT, then that will be a restriction, which means the REIT cannot put the money in the conventional bank, although it gives maybe better FD rates and stuff like that. So it depends on the market rate at the time, which one gives better deal. But regardless what, right, the REIT will have lesser choice when it comes to choosing their financial product. The next one would be, of course, the financing. When you want to buy a piece of property, the mortgage or the financing, conventional loan better or Islamic financing better? So which one will give better rates? So what I can say here is that REITs will have lesser choice when it comes to choosing their financial products, how they finance. If let's say the conventional loans are giving better rates than the Islamic financing, then cannot law. You have to go with finance. You have to go with a higher cost one, which is the Islamic finance. So that could be the restriction. But on the flip side, if Islamic financing is better, then by all means, that could be an advantage to the REIT. The third one is you cannot simply just choose any insurance company. You can only go with a takaful operator. So if the insurance charges for a conventional insurer is lower, then that's the one. Then the REIT cannot go with that conventional insurer. You have to stick to the takaful. But of course, if the takaful gives a better rate, then by all means, that would be a great thing for an REIT. Okay, so I have done with the part one, which is the difference between conventional REIT versus REIT. So now I'm going to do a case study. And this case study, right, there are two parts to it. The first one is this. I'm going to do a 10-minute test, which is how I do it for every single REIT, whether it's REIT, conventional REIT, whatever REIT, I'll go through this 10-minute test. Okay, so that will be part one of the case study. And part number two, I'm going to go through with you. So this will be like a mini workshop where I'm going to demonstrate to you how to calculate net distribution yields. And this kind of thing, right, there's no choice. There's no screener for it. You can't just go to screeners to obtain this kind of information. It has to be, if you are an investor and you want to calculate the net distribution yield, you have to do it manually. Okay, because there's no screener that provides this kind of service at the moment. All right, so let's get into it. So that will be part two. Let's get into part one first. So part number one, I'm going to just do a 10-minute test on the REIT's financials. And to do the test, I'm going to use Axis REIT as my case study. But before I get into Axis REIT, so let me just share with you what is the main objective of this 10-minute test. Okay, so the main objective here is to assess if the REIT, let's say Axis REIT, is one that I would continue to spend more time to study further about the REIT before I make an investment decision. But of course, if an REIT or any REIT fails this 10-minute test, then I will not continue on my study on this particular REIT. Okay, so to pass the 10-minute test, it must actually fulfill these 6 criteria over here. So I put through the REIT in a very stringent 10-year test. All right, so these are the 6 things that I will look at. Let's look at the first 3. All right, the first one will be revenue, net property income, and distributable income. So these 3 I will put through a 10-year test. Why? This is because I want to know over the past 10 years, let's say from 2011 to 2020, whether or not a REIT can or has the track record of growing its profits consistently and deliver consistent growth when it comes to its income distribution to its unit holders throughout the 10 years period. Not all REITs can actually do that. So if a REIT can actually do that, consistently grow its profits and income distribution to its unit holders, then that's the REIT that I personally would prefer. All right. So that will be the first one. Now, when it comes to the fourth one, as you can see, we can have what I wrote here is 10-year total assets and 10-year net asset value. So these 2 over here is to talk about whether or not the REIT is proactive enough in growing its real estate portfolio over the past 10 years. So of course, if let's say the REIT is proactive enough to pursue acquisitions opportunities, all right, means to say they want to add on to their portfolio, or let's say the REIT is into asset enhancement initiatives, which means they want to renovate the property, refurnish the property so that they can enhance the value of the property. I want to see, so if a REIT is very proactive in doing these 2 things, the REIT should actually report continuous growth when it comes to its total assets and as well as its total asset value. Okay, so this is the 4th and the 5th one. And finally, the last one, current gearing ratio. I will calculate the current gearing ratio, or alternatively, I would say it is actually given in the presentation slide. So sometimes you don't need to calculate, you can just refer to the official slides of the REIT itself to find out the current financial strength of the REIT. So with that, let's go. Let's put this REIT Axis REIT into the 10-minute test. Okay, so with that, I need the help of the Bursa Malaysia website. So here you go. This is the Bursa Malaysia website. Or, okay, let's say, for example, you're starting from scratch. Just put it in Bursa Malaysia. Let's go to the official website. So if you see company announcements, just click onto this. Scroll down. Annual report, and then the case study of today, Axis REIT. Click search, and you'll be given a lot of financial reports all the way to 2005. So what I will do is that typically I'll read the entirety of its annual report from, I will backdate it to 10 years, all right? Typically that's what I do, but right now for this webinar, we are going to do a 10-minute test. So I'm going to just show you in brief how it's done. So I'll just download the 2020's annual report. So the first 3 here is that I'm gonna go through the first 3 tests, which is the 10-year revenue, the net property income, and distributable income. Okay, so these figures, right, you can, I'm gonna show you a shortcut to this. So the shortcut, you can actually find it under financial review. Is it too small? Maybe I should enlarge it.
Yeah, you enlarge it better.
Okay, so let's enlarge it. Okay, so just go and find this financial review. And what you'll be given is a summary of results, and you can compile up to 5 years. Okay, so which means if you want something from 2011 to 2015, all you need to do is just go to the 2015 report and download the report, and you will get the summary of results from 2011 to 2015. And from there, you can very easily take a look at the total revenue, the net property income, and as well as the distributable income of Axis REIT. So all you need to do is just copy and paste this data, and I have already done over here. the full 10 years when it comes to revenue, net property income. So it's all compiled already. So I'm just telling you where is the source. And last but not least, we have this income available for distribution. So this is actually another word for distributable income. So where do I get this figure is that I just need to scroll down. And all I need to do is just find this column, income available for distribution. And all you need to do is just copy and paste these figures and put it onto the slide like this. Okay. So this is basically a copy and paste job. And now what I'm going to share with you is that what I love to do is that I love to plot graphs. Okay. So let me just quickly show you a simple graph that I love to plot whenever I assess a stock, any stock. Okay. So I have converted this into millions. And I love to plot graphs like this. And I'm going to do a bar chart. So over here, as we can see, all right, from here, we can safely say, data label. From here, we can say that, can you see that over the past 10 years? So this is the total revenue figures for Axis REIT. And what I can say is that Axis REIT has actually delivered continuous growth when it comes to its total revenues from 114.3 million ringgit to 232.2 million ringgit. So as you can see, if you see this kind of growth, this kind of nice looking pattern where it actually continuously grow, then this is actually the kind of stock that I personally love to keep. Okay. Actually, most of my portfolio, I would say all of my portfolio, right? When it comes to my stocks, right, they will actually consist of this kind of pattern only lah. All right. So that's why I love to plot this kind of graph, and I like to actually keep stocks like this. Okay. And now we can actually look at net property income. So what I'll do is that I'll do the same. I'll just plot a simple graph like this to actually show what is the net property income like for Axis REIT. So as you can see, it's the same pattern where it has actually delivered continuous growth when it comes to its net property income over the past 10 years. So this one I think is actually very healthy. And then the third one will be income available for distribution. And again, it actually has shown this kind of pattern where it has increased from 65.9 million and it has grown all the way to 126.4 million. Okay, so if I find this pattern, then I probably would say, okay, I will actually study further. I will actually investigate why the Axis REIT can actually deliver such kind of financial results. But that is actually after I have done the 10 minutes test. So for now, I would say that total revenue, net property income, income available for distribution, I would say it is okay. This is the kind of thing that I personally like. All right, so that is actually part. So actually that is the profitability part. Now let's look at the total assets part. So total assets, right? So where do you get this figure? You can also find it from the financial review. So all you need to do is just scroll down. Well, there are actually few places that you can actually get the total assets. So it's over here. So we have the total asset value and as well as the net asset value. So again, what I will do is that I will just copy and paste these figures and put it on a spreadsheet like this. And then the same thing, it's actually the same thing here. I will actually go and plot the graph. So I just want to see the pattern for the past 10 years, how the total asset figures look like. So let me just quickly plot the graph for you. Okay, so let me just, so now you see the figures here are a little bit messy. So I'm just gonna delete the 1 decimal places. And right now what I can see is that Axis REIT, right, for the past 10 years, it has increased its total assets from 1.3 million 1.3 billion ringgit to 3.4 billion ringgit, and it shows a consistent growth. So this one is actually okay. And by the way, you may want to ask me, what is the difference between total assets and total net asset value? So what is the difference between the two? Well, the answer is very simple. Total assets is just total assets. Total net asset value is you take the total assets and you minus off all the liabilities. Then you get the total net asset value. Okay, so this is like your shareholders' equity in other stocks. Okay, or let me just put it another way. So let's say, for example, you have a house, and the house, the total asset value, the total asset here is, let's say, is actually like the market value of your house. Like, let's say the house is worth 1 million ringgit. And let's say you have a liability of, which means your outstanding mortgage of 500,000. So therefore, your net asset value, right, should be 500,000 because that is your property equity. So this is the value of the house, and this will be the value of your property equity. So what you need to do, so what I will do is that I will also plot a graph like this. Scroll down, and there you go. All right, so I can see that the total net asset value has increased from 944 million ringgit in 2011, and it has grown all the way up to 2123 million or 2.12 billion ringgit over the past 10 years. So I think that is actually pretty okay. So it has delivered consistent growth when it comes to its total net asset value. Okay. And finally, we will move into current gearing ratio. So current gearing ratio, okay, there's a way to calculate, but instead of calculating, I'm going to just share with you a really cool trick about Axis REIT. So when it comes to Axis REIT, right, here is the way to find out a lot of things about Axis REIT. So go to the corporate website of Axis REIT, click onto investor information. All right, you will be presented, then you just go down to reports. There's an annual report and there's a quarterly report. Just click onto quarterly report. Now, above this quarterly report here, there's quarterly report and quarterly presentation. So you just click onto quarterly presentation, and each and every single quarter, Axis REIT will come out with their presentation slides. So you just need to download this, and everything has been tabulated nicely for you. Okay, so if you want to find out about its gearing ratio, all you need to do is just go straight to its financing data. So let me just scroll down very quickly. Okay, so it has the financial overview over here, and what you can see is that we can see that there is total financing. Okay, so this is the amount. In conventional REIT terms, this is more like borrowings, but because these are REIT, so we use total financing. All right, and they divide it by the total assets, and therefore you have the gearing ratio. So over here, as you can see, the gearing ratio has been 35%, 33%, 37%, 28%, 33%. So it has remained around 30 to 35% over the past 5 years. So that is actually pretty okay. Now, just to dive in deeper a little bit, over here they also report the effective profit rate. So this is the rate that they pay to get the financing from the Islamic bank to finance their properties. So the rate has actually kind of like dropped from 4.32 or 4.37 in 2019 to 3.89% in 2020 lah. Okay, so that is a drop in effective profit rate, which is quite similar to our mortgage rates also dropped, our FD rate also dropped. So understandably, the effective profit rate also dropped lah, all right, in 2020. And now if you want to see the percentage between floating rate and fixed rate, right, then you can just refer to this chart over here. So fixed rate means it's fixed. Floating means it actually depends on the BLR. It depends on the BLR. It depends on the OPR rate announced by Bank Negara Malaysia. So you can say half of the financing, almost half, a little bit more than half of the financing is based on fixed rate, which means it's not affected by the BLR changes or the OPR changes. I wouldn't say it's BLR, it's supposed to be BFR, right? Because it's base financing rate, because it's Islamic, all right? So that one, so the one that is affected by the financing rate would be the 47%. And the one that is not affected at all by any changes in the OPR rate or the base financing rate will be the 53%. Okay, so this is everything that you need to know about the gearing ratio and the financial standing of Axis REIT. Okay, so far so good. So Shane, any questions from our audience so far? If not, I will move on to the next part, which is the calculation of net.
Yeah, there are of course the questions, but I think we leave the question towards the end.
Okay,
Okay,
lah.
but since you talk about questions, right, I want to remind our participants that if you have any question who want to ask our speaker, type in the Q&A, okay, not type in the chat, because chat box, right, because with all the overflowing messages, then we may overlook it. If you put in Q&A, then it's easier for us to manage. So if you want to ask Ian any questions, type in the Q&A box, not the chat box.
Okay, so with that, right, I'm gonna just continue on. Okay, so you may actually wonder, Ian, all these things are quite elementary, like I just need to copy and paste the revenue, the net property income, the income available for distribution, and from there, that's the 10-minute test. And my answer to you is yes. Actually, for me, right, the way I assess stocks, right, actually it's quite simple and elementary. Anybody can do it. It's just a matter of effort when it comes to downloading the annual report, compile the data, and from there just assess the finances of the REIT. And from there, I get to know which of these REITs are actually working and which of these REITs are not exactly working. All right, it's all through these financial reports and through this copy and paste of financial data. Okay, so it is actually that elementary. I mean, at least for me, that's my whole process of assessing a stock. So now we are going to look into the next part where we are going to calculate the net distribution yield, okay, which is the part where there's no screener to help you. You can only do this on a manual basis. So here I'm going to share with you how it is done, okay. So now this is actually the company announcement of Axis REIT. So what you need to do is that you need to just number one, there's no category for it, so you just leave this blank, okay? Or let me just reset the whole thing. Let me just reset, okay? Or I refresh. Yeah, okay. Let's just reset. So let me just type back Axis REIT. So in order to calculate the latest or the current net distribution yield, what you need to do is that you need a few figures. You need 4 figures, the 4-quarter figures, or I would say the latest 12 months declaration of the income distribution from a REIT. So what you need to do is just you need to painfully scroll down from the what do you call the company's announcement. Okay, so you need to continue to scroll down. So you need to do this on a manual basis. And then notice we have this thing called the income distribution. So you can click onto this and you'll be given 2 figures. Can you see this final income distribution of 2.25 cents per unit, of which 0.83 cents per unit is taxable, and 1.2 cents and 1.42 cents per unit is non-taxable in the hands of the unit holders. So what does it mean? Okay, so I'm going to just compile this figure. Okay, so we have period. So this, I believe, will be Q4, final income distribution. Yep. So let's put this as Q4 2020, Q3 2020, Q2 2020, Q1 2020. Okay, so we have the gross DPU. We have the taxable DPU. And then we have the non-taxable DPU. So Shane, is it too small or should I actually just enlarge this?
I think it's okay, but if you can enlarge it, that would be better.
Let's enlarge it. Okay.
Okay, perfect.
All right, so let's enlarge this, make this into center. And the first thing you need to do is just compile. So we have 2.25 cent. And then we have the 0.3 cent, which is taxable. And then we have the non-taxable, which is 1.42. Okay, just leave it as it is for now. And now we are going to just, and now from here, right, we need another 3 more quarters, the previous 3 quarters income distribution. So with that, we need to scroll down. The reason why we do this, right, is simply because although the REIT, right, will give you the 2.25 figures, you can find this in the annual report or any screener. But the thing is that these taxable and non-taxable figures, right, they are not exactly given anywhere. So in order to really, really pinpoint, calculate the net distribution yield, right, you need the DPU, the taxable DPU figures, and as well as the non-taxable DPU figures. So as you can see, we have another one, income distribution. So over here, it says the third interim income distribution, which is 2.25 cent, of which 1.84 cent is taxable and 0.41 cent is non-taxable. So can you see that although the gross DPU is the same, but your net, what is given to you at the end, what is the cash that you receive in your bank account at the end will be very different depending on which portion of it is taxable and which portion of it is not taxable. Okay. And now let's move on to the next one, to the previous one. And we just quickly compile it. So let's see. Okay, so we have the next one, which is another income distribution. So it says second interim income distribution, which is 2.15 cent, and of which 1.64 cent is taxable, 0.51 cent is non-taxable. Okay, so now let's go on to the final one, which is the first quarter's income distribution. And with that, let's go on to the company announcement to find out. All right, we should be very close to getting the figures. All right, so we have the first one, I believe. We have the first interim income distribution, which is 2.10 cents, of which 1.59 is taxable, 0.51 is non-taxable. Okay, so now we have the taxable and non-taxable. So this should add up to be 8.75 cents, which is exactly the gross DPU, 8.75 cents. So now, under the LHDN, the thing is this, for investors, individual investors like you and me, like me and Shane, we buy it at our own capacity. So what happened is that from this taxable DPU declared, right, we'll be given the taxable DPU netted of 10% withholding tax. Okay, so which means to say whatever we receive here, whatever is being declared here, we have to pay 10% withholding tax to the LHDN, and what we get is the net. Okay, so the first thing we need to do is that we need to sum up this one, which is 5.9, and then we have to multiply. So we have to multiply D7 with 0.9. So at the end of the day, the final amount that you get from this taxable DPU is 5.31 cent. Okay, and when it comes to non-taxable DPU, you will get this sum in full. So I'm going to just copy and I'm going to just sum this up. And the summation of these 4 quarters, right? 4 quarters worth of non-taxable DPU is 2.85 cent. So you get the net, you get the taxable DPU net after the withholding tax, which is 5.31, plus the non-taxable DPU, which is 2.85. So therefore, your net DPU at the end, let's do this formally. is 8.16 cents. Okay, so this is actually the net DPU for 2020 for Axis REIT. So now you can use this figure. You can actually use, can show Google Finance, Shane, or I use the Bursa Malaysia website to get the Axis REIT's stock price.
I think you can use Google Finance.
Okay, all right, so let's use Google Finance. All right, all right, because it's a lot faster. So the thing is that, okay, Axis REIT right now is priced at 1.91 cent. So what you can do is that, so the stock price, is 1.91 cent. So what you do is that you have to take F8, which is 8.16 cents. You have to make it into Malaysian cents because what I showed here is just cents. So you have to convert it into ringgit, and then you divide it by the current stock price, which is 1 ringgit and 91 cent, which is G8. Make it into a percentage. So therefore, your net DPU, your net distribution yield for Axis REIT is calculated as shown on the screen, which is 4.27 cents. But is this a good thing? Is this a good rate? Well, that one I leave it to you because it depends. If, for example, if you're listening today, you think that 4%, anything above 4% is good, then of course you may consider Axis REIT. But of course, if let's say your criteria is anything above 5, then of course 4 is actually a bit short of your criteria. But for me, I will personally do this calculation I'll backtrack it for the past 10 years. And then from there, I will calculate the average yield. And from there, I will compare whether or not this 4.27%, whether is it below average, or is it more or less or closer to the average, or is it like above average? So that is actually what I would do as an investor before making a final decision. Okay, but anyway, this is actually the formula that I use to calculate net distribution yield. Okay, so if you look at its annual report over here, so this is the annual report. The thing is that, okay, the annual report will give you the gross distribution per unit, which is 8.75 cents. Okay, let me just move it close to my spreadsheet. Okay, so they will give you 8.75 cents, but they don't give you the breakdown of taxable and non-taxable. So this thing you need to rely on the Bursa Malaysia website in order to get the breakdown so that you can calculate the net DPU for any REIT in Malaysia. Okay, so this is actually the demo, and that will actually conclude my case study. So whether or not you will continue on with looking at Axis REIT, okay, because there's so much to study about a REIT. You may want to study about its property portfolio, its future growth prospects, who own Axis REIT, how do you see the industrial property sector in the future? So this one, it's actually another level of study. And after you have done that, you can do the valuation, and finally from there you can make your final investment decision. Okay, so with that, I would like to thank you for listening, and I believe that you have prepared a lot of questions to ask me. So I'm going to pass back the control to Shane. So Shane, take it from here.
Yes, thank you so much, Ian, for your sharing on Shariah-Compliant REIT.
Yep.